at least as we sit here today, it does look like inflation is coming back down. The blue line is going to be your headline inflation. The white line is going to be what they call core inflation, which excludes energy and food, but both of them generally are trending in the same direction. Perhaps you could make the argument that the headline inflation, which includes food and energy, is coming down at a faster rate. And maybe there's an argument to be made that core inflation is a little more sticky, perhaps because of things like wages, shelter being a little more sticky. But nonetheless, I think this is incrementally good news. There's a hope within the market, and certainly at the Fed, that this trend will continue. So what's the bad news, or what's this thing that Nick's been warning us about within the financial sector? Well, the issue is we still have inflation sitting up around 6%, and the Fed's goal, their stated goal, is to have something closer to about 2 to 3%. So their job's not done with regards to hiking interest rates. So the unfortunate thing is, this rate increasing cycle, which we've seen over the last 12 to 15 months, which has been the fastest in history, taking us from about 0% all the way up to today, 5% interest rates. It looks like the Fed's job is not done to really bring inflation down to where their target is. Now, I've got this quote up there in the top left corner: hike until something breaks. It's, maybe a little tongue in cheek in throwing that quote out there, that saying out there. I was talking to my analyst a couple weeks ago, and he was like, "What do you mean something breaks? What does that actually look like?" Well, we, on about 2 days after our last cup of Joe, we saw what something breaking looks like. In fact, we saw it a couple times. And again, I don't want to tell everybody to make a run on your bank. This isn't It's a Wonderful Life. I don't want everybody pulling all of your deposits out. But on March 10th and on March 12th, we had the number 2 and the number 3 biggest bank failures in the United States history. And that sounds like a lot, and it is a lot. This is a big deal. And I'll get into a little bit of the detail on what happened. And I apologize. I do want to get a little into the weeds on this one because it's a new topic, and it's something that we probably will see, flying through the headlines for the next potentially couple months. So this is where I get a little into the weeds, and I apologize if people's eyes glaze over. But ultimately, think of it almost like a risk diagram of many of the banks within the United States. And the way to look at it would be the x-axis, so going left to right. That is the losses of as interest rates hike and banks are taking their deposits or their capital, basically their regulatory capital, and they're investing that into things like treasuries. The x-axis represents what percentage of that regulatory capital is experiencing losses. The y-axis, which is looking at the level of deposits that are in excess of $250,000. Now, many of you on this call may be saying, I don't have anywhere near $250,000 at the bank. And I would say that probably makes sense. You probably shouldn't have too much of your money sitting at a bank because it really isn't earning you a whole lot of money. So just having cash sitting at a bank in excess of 250 grand isn't keeping you up with inflation. But the other thing that it does, if you're above $250,000 in deposits at a single bank, that money in excess of 250 grand is not insured by the FDIC. That's the Federal Deposit Insurance Corporation. If you didn't understand any of what I just said, think of it this way. The further you get into the top right corner of this chart, the more losses you have on your investments and the more deposits you have that are in excess of that insurance threshold. Or in other words, these are uninsured deposits and the bank is losing money, is basically the way to think about it. Perhaps no coincidence, as we look up in the very top right corner, that SIVB, that's Silicon Valley Bank. That is one of the 2 banks that failed, and they failed in a very quick fashion. The other one, which is highlighted up in the top middle, that's Signature Bank. So that bank is actually going to be out of New York City. Obviously, as we can see on this diagram, it kind of makes sense. Both of those institutions had one thing very much so in common, which is a lot of their deposits were in excess of $250,000. So what happened? You literally had a situation where there were a number of very wealthy depositors, either individuals or corporations, who had their money sitting at these two banks. And my guess is they took a step back and they said, there are some headwinds in the economy. I've got a lot of cash that's uninsured and sitting at this bank. Why would I do that? If I need to have money sitting in a bank account, why don't I reduce it out of Silicon Valley Bank, Signature Bank, and distribute it across a bunch of different banks to get it back down into an insured level? And that's what happened. And unfortunately, and we don't see this often, but it can happen in a very quick way. And the way banks are set up, when that does occur, it makes it so that the profitability of these operations can tailspin fairly quickly. And we saw that in a matter of a couple of days, both of these banks failed. Additionally, we ended up seeing Credit Suisse out of Europe, they failed. And then as we look here in this chart, in kind of the middle upper section, FRC, that's going to be First Republic Bank. And they're currently in the headlines very heavily right now because they too have a situation where they've had a fleeing of deposits, and perhaps to no real fault of theirs. It's just they had a lot of wealthy accounts sitting at their banks. Well, they realized that they weren't really insured, they weren't protected on those funds, and they decided to diversify their money across this. So that's really the crux of what's happened, is interest rates moving up very, very rapidly, and then people having a lot of money well beyond what the FDIC insurance limit was. And they said, we need to figure out this risk. We need to take it elsewhere. Well, and I guess the other thing I would say is those two banks would be considered more on the regional side as we think about some of the bigger, quote, too big to fail banks, JP Morgan, Wells Fargo, Bank of America, your bigger kind of household names. You may think, oh, well, those banks aren't at risk of these same things because they're bigger and they can't fail. Well, I would actually argue that they're probably seeing some of the same things as well, maybe not to the same degree, but what, I guess what I want to do is I want to revert back to this chart, which is showing interest rates have gone from 0% to 5% in the last year. So hypothetically, you could think to yourself, well, why am I not receiving 5% at the bank? But, if interest rates have gone up from 0 to 5%, why are you not getting 5% on your deposits? I looked before I hopped on the Cup of Joe. JP Morgan, for example, and don't get me wrong, great bank, they pay 0.1% on their deposits. And that's despite the fact that interest rates have gone up by 5%. So I do think you have a function of people saying, well, why in the world would I hold my money at a place where I'm getting 0.1% when I could go out and I can buy short-term treasuries and I could get 4%, 4.5%, and actually keep up with inflation a little bit. And what this chart is ultimately showing is basically that. With the white line is going to be US commercial bank deposits. And this is all over the last year. So this is basically since the Fed began hiking interest rates. That's going to be on the left axis. So it's gone from, let's call it $18 trillion down to about $17.5 trillion. And that's trillion with a T. So even though it may not look like a big amount or a big drop, that's $500 billion that has moved out of the banking sector. And that's not just regional banks, that's big banks, small banks, all of them. The blue line is that's showing the level of assets at money market funds. So a money market fund is basically a mutual fund that typically invests in things like short-term treasuries, very, very high quality, short duration, but now decently high yielding treasury securities. So what you're seeing is people taking money, not just out of regional banks, but taking money, if they have a little excess cash, a lot of people are saying, why don't I take this and move it into a money market mutual fund where I can get 4.5%, actually help to fight inflation a little bit. And you can see the blue line has basically been a mirror image of bank deposits. And that's completely a function of people wanting to, one, diversify away their risks. So if they were above the FDIC insurance level, they want to split that money across more banks. And then the other thing is there's a hunt for yield. And the hunt for yield is looking for things like treasury bonds, treasury bills, and money market accounts. And that's really what this chart is showing, is really no bank is safe unless they're willing to offer a competitive rate and a competitive yield on your money. So I know I rambled on quite a bit, but I did want to make sure I touched on that. It is worth noting that in the next week or two, we're going to start to get some of the Q1 bank earnings, and there's going to be a lot of fine-tooth comb going through all their financials to make sure that they're safe, that not too many deposits have fled, that they can still operate. And there are going to be winners and losers here. There's no doubt about it. But that's kind of how the banking system as I'm viewing it right now. And unfortunately, we've had a couple failures, and they were extremely quick. And there will probably be some knock-on impact from this, because what I really want to hone in on is, you're probably hearing all this saying, that's all well and good, Nick, but what does that mean for me? What does that mean for the manufacturing sector? Well, this is really where that's summarized. The left-hand side is showing, and this is going all the way back to 2000, it's showing the percentage of businesses witnessing tighter lending standards. So that would be things like, higher rates or more difficulty to get a loan. And then the right-hand side is showing percentages of businesses witnessing stronger demand for loans. And you can see the two charts are really going the opposite direction. And what it ultimately summarizes into is credit conditions, lending, the ability to get money, said another way, is getting more difficult. And I would suspect that as we go into the second half of this year, these situations are likely going to feed through into the economy, because make no mistake about it, the credit system of the United States and the banking system, loans and credit are the lifeblood of an economy. And I'm not saying that they're going to cease to exist, but they're certainly going to be more expensive. There's no doubt that banks are looking at every one of their portfolio companies and the individuals they lend to, and they're just having a slightly higher level of scrutiny around those lending practices. It's probably worth noting, and we've talked about kind of the revenge of the old economy in prior Cup of Joes. There were 64,000 startups that banked with Silicon Valley Bank. Their name kind of says it, Silicon Valley Bank. They operate in the West Coast, mostly with startup type entities. I would expect the pain to be a little more painful within that side of the world than our traditional manufacturing companies. But I think across the board, this situation where you have bank failures, it's going to make all banking executives take a step back and say, we probably should be a little more conservative, be a little more prudent with our money, and we may even see some additional regulations as we roll through the next few months.
Nick, just so I'm reading this right, demand is going down because it's tightening, right? Because it's tight. It's not that less are in need of these loans. It's just that the demand is waning because they just can't get it. Am I reading that correctly?
Can't get it, and even for those who can, the interest rate's gone from 0 to 5%. So if that's related to a mortgage, there could be a lot of people who are moving off, or moving back to the sidelines because the rate to finance a car or finance a house has gotten a whole lot more expensive.
One question: Have you seen the price of gold spike at all throughout this?
Yeah, there has been. So there's been a little bit of a weakness in the U.S. dollar, and there's been certainly a risk-off move into gold. Gold tends to be kind of a flight to quality type asset, and there certainly has been both in gold and silver in the last couple months.
Yeah, interesting.
Yeah. So we're left with this scenario that Jay Powell is kind of sitting here at kind of the fork in the road, thinking, one, do I take the path of continue hiking interest rates at the risk of potentially blowing up more banks, potentially bankrupting more startups, causing more economic weakness? Because that part of that would be the intent of bringing inflation down. So that's why you would continue hiking, but there are definitely going to be some externalities with doing that. The other alternative is you ease rates, you actually begin taking interest rates back down. The issue with doing that with inflation still at 5 or 6% is you didn't really accomplish your goal. And if you start to ease, do we see oil go back to 100 or God forbid 120, 130 or something like that? Inflation really start to perk back up, and then they have to go back to the drawing board and figure out how they're going to fight that. For now, the odds best bet is they're going to pause And by pausing, it simply just means they're not going to hike, they're not going to ease. They're basically going to take a straight line through that grassy area in the middle of the two, and then just watch the data. That's what it looks like they're going to be doing for the coming weeks and months, is every single CPI data point that comes out regarding inflation, every data point regarding employment. They're going to be watching these with a fine-tooth comb, and every single one of these that comes out is going to change their outlook on whether they want to remain hawkish and keep tamping down the economy, or if things continue to break, financial system needs some help, maybe they start to ease. Unfortunately, in my opinion, if they do go the route of easing, it probably won't be because things are going well. In my opinion, if they start to ease, it's because they have to, and things are getting a little tricky. So for now, it looks like for the next couple meetings, the expectation is they're going to pause, they're going to watch the market, they're going to see how data comes in. Because don't get me wrong, some of these things are going in the right direction. As I mentioned, inflation is coming down. Employment is getting a little trickier. We oftentimes talk about job openings. Job openings are there's still a lot of them, but they peaked out around 12 million people. They're down at 9, I think it's 9.5 right now. That's still about 1.3 jobs that are available for every person looking for one, but it's going in the direction that the Fed wants, which is to cool down the economy.